like to welcome you all today in joining our presentation on unlocking some of the key principles in achieving your financial goals. I'd like to introduce myself, Dean and and my business partner, Emilio, who are both directors and financial planners at Intergenerational Wealth. We run this presentation along with the Melton City Council Learner Directory. Just a quick disclaimer on what we're doing today. It's important to note the information we're giving is general advice only and doesn't take in consideration your needs, objectives and financial situation. So if you need to talk to someone, please contact us directly. Today we'll be covering off on a range of different topics. Some of the key principles to achieving your financial goals will cover off managing cash flow, the importance of diversification and motion and time in the market as opposed to trying to time the market. We'll also look at the current market volatility and what the recovery looks like for the economy, and also covering off some retirement tips for you all. The first point is around managing cash flow. It's really important that when you manage your cash flow, particularly in times like these where you may have seen your income reduce or been affected by the coronavirus. The most important thing that we can do at the moment is look to set a budget. I'm always surprised to know how many people don't know how much money comes in on a weekly, fortnightly or monthly basis from their employer. And also then understanding how much money is going out on those terms as well. In trying to ascertain what your budget is, the most important thing to do is to note things down. This can be done in a variety of ways. It could be the old-fashioned way by just using a pen and paper. You can use an Excel spreadsheet, or there are so many different apps available on people's phones these days that can do that for you as well. Once being able to ascertain what your budget is, it's then about to split this between your fixed and your discretionary cost. Fixed costs can be such things as your utility bills, water bills, car insurance. These are things that we have to pay and don't really have a choice. And then there's a discretionary cost, where these are things that really are things that we want, including Foxtel subscription, ordering Uber Eats on an ongoing basis. And this is where we see the most opportunity to be able to reduce cost and also then lead into savings. Give you an example, I guess at the moment what we're seeing, there's not a lot of sport on. So the $25 a month that we are paying for our Foxtel sports subscription can probably be put on hold for a period of time until we start seeing live sport again. Once we undertake and understand these savings, it's about working with your financial advisor to work through what you can do with these savings. And this can be covered off in a variety of different matters. It can be used to reduce debt, put into a savings account that you can't touch, and also put into things like superannuation to help you save for retirement. When we understand these things, this is really, we can really add to our wealth and generate wealth for the long term. So my top tip in really looking at your spending is to actually change your expenses or to change the way you spend based on your situation. So at the moment, if you are finding the income has reduced, it's about finding ways to reduce what you are spending. So that may be cooking at home more rather than ordering Uber Eats or Deliveroo or whatever that may be. Once you're able to ascertain these savings and then work out what these costs are, it's really easy to manage your budget on an ongoing basis. If you are really struggling and can't meet these expenses, I guess the government has brought a range of stimulus packages that can help people, whether it's accessing super, talking to your bank or your mortgage broker to help with your debt costs as well. As I mentioned, there's a whole range of options of what you can do with your savings, and that's about looking at your investment options and really talking about the importance of diversification. And whether that's diversifying into cash, fixed interest, property or shares, they are really important aspects of where you place your money. Being diversifying across different asset classes allows you to reduce your risk on an ongoing basis and really trying to monitor the different times in the market where different assets will perform better than others. This is really important, particularly in times as we've seen at the moment. What we're seeing at the moment is the share market has taken a really big hit, and therefore having exposure to cash and fixed interest within your portfolio does allow you to mitigate some of these risks as well. As I mentioned, the most important thing we're trying to get into the market is not necessarily trying to predict when to jump into the market, but actually spend time in the market. The most important thing you can do is set a long-term goal and objective that allows you to spend time in the market and allow for compound interest and take advantage of the situation to accrue your long-term wealth. The most important element of this is not trying to pick the assets that you want to be in either. As you can see by the table that we're showing at the moment, and really highlighted in green are the best performing assets in any one year. This table goes back to the year 2000 and really shows the jump around in different asset classes that will perform better in different years as well. So as you can see, you can't pick a particular asset and stay in there for the long term because it won't always perform the best in any one year. So it's really important that we diverse across these asset classes to take advantage of these different times in the market. Now I'm going to pass on to Emilio. Emilio's going to cover off a couple of different areas. He'll talk about the current market conditions and what a recovery looks like, and also give you some retirement tips.
Thanks for the introduction, Dean. There's no doubt our markets have taken a huge hit over the last few months, especially in early March as we saw the first significant phase of the COVID-19 pandemic hit. Fortunately in Australia, we've seen our share markets regain significant grounds as a reflection of massive policy support from the government, as well as success in flattening the infection curve. The challenges we will face over the next phases of the virus, however, as both the domestic and global economies gradually reopen and attempt to recover, are no doubt significant. We look at the recovery as a potential of perhaps three scenarios. The first and most ideal is a V-dip. So that's where a vaccine is developed and we'll see significant containment of the virus as a whole. And this will enable the economy to bounce back fairly rapidly as we go back to as close as normal as possible, without fears around second or subsequent waves. The second scenario is the U, which follows a similar path with the virus containment. However, the road to normality in the economy is a slow recovery. This will follow the slow and gradual reopening of the retail and hospitality sectors as governments remain cautious about allowing a full back to normal as we know it. The third scenario is the L, which would see us stuck in a second or subsequent waves of the virus as a lockdown. This would obviously have the most dire consequences on the market as we continue to have to operate in stage 3 lockdown as we currently know it today, or perhaps even get stricter and move towards a stage 4. It is still very hard to tell which of these might occur. We are all very hopeful for a V, but we perhaps see U as the most likely, with a slow upward recovery. Unfortunately, we can't rule out the L as we wait for a vaccine. We can only hope that the worst is still not to come. The positive in Australia is that we're in a very strong position with strong and decisive fiscal policy and a very strong health system ready to respond. There is no doubt the US remains a large risk to the global markets though, with their health system struggling to cope with the virus numbers, and although attempting strong fiscal stimulus, the path of the virus over the coming weeks will dictate how the US is able to continue to respond and recover. So while the markets has certainly rallied, we would take a very modest view on riskier assets. We certainly can't rule out future volatility in the share markets over the short term as we try to recover, and perhaps a reinfection may occur. As Dean mentioned earlier, it's always important, but particularly so during these volatile times, to have a diversified portfolio to mitigate your level of risk and ensure that you're taking the appropriate levels of risk that you can tolerate. That's a wrap of where we see the state of the markets at present. So now I'm going to move on to planning for retirement. How much you need at retirement will depend on a number of factors. When you are planning to retire, how much you need to live on, how long you want the funds to last for, the expected returns over time, and whether you will qualify for government entitlements. So as you can see in the slide there, we can model the outcomes to any scenario. So I'm just going to focus on one scenario today, is the assumption that you as our client require $60,000 per annum to live on, achieving a 5% return for you, and you qualifying for government entitlements. So if you want to retire very early, in your early to mid 50s, and you want the funds to last for 35 years, then you'll need around $1.1 million at retirement. If you want to retire at around 60 and you want your funds to last for 30 years, then you'll need to have around $800,000 at retirement. If you want to retire around the current normal retirement age, around the mid 60s, and you want your funds to last for 25 years, then you'll need around $600,000 at retirement. From the table that you can see on the slide, just want to make you aware that we've modelled the government pension entitlements as they are today. As we know, it can change over time. Will likely be the case in future years, especially with the government's budget running into a significant deficit because of the stimulus payments that they have been providing for COVID-19. So just be wary of that. We've also provided details on how much you need without any government entitlements. So it's going to be between those two figures that we'll be aiming for when we're planning for your retirement. So now I'm going to move over to some tips on how to achieve your retirement goals. So some tips have already been mentioned and I won't elaborate on. So they are things like spending less, so Dean covered off on that, and also working longer. So they speak for themselves. The other tips that I want to spend more time on are investing into super using pre-tax dollars, investing more aggressively, downsizing your home, and seeking advice from a financial planner. So investing into super using pre-tax dollars means that making contributions into super through means such as salary sacrifice or tax deductible contributions into super. Okay, so the average Australian marginal tax rate is 34.5%, and this can be as high as 47%. So that's the amount of money that the ATO are taxing you before it gets to you. Okay, with using pre-tax dollars or pre-tax contributions into super, this reduces the tax on these funds to 15%, so a significant tax savings. So by using those significant tax savings, you are building your superannuation savings a lot faster. Just also note that the tax rates on these contributions into super can change to 30% if your income is above 250,000, and also the government have placed restrictions on the amount of tax deductible contributions that you can make into superannuation. So the earlier that you start contributing into super, the better off you are going to be. The next tip that I'm going to talk about is investing more aggressively over the long term. So this doesn't mean that you need to invest in risky investments. It means over the long term, exposing yourself to more growth investments, such as blue chip shares like major banks opposed to defensive investments like cash and term deposits. The next tip that we're going to speak about is downsizing your home. This means unlocking the equity in your home by selling it and possibly moving into a smaller property, which when we're older may be a benefit in itself physically, as a smaller property will be easier to maintain. Financially, by unlocking this equity, we can utilise these funds for your retirement. Further to this, the government have now allowed you to use your sale proceeds and invest in super post your retirement as well, so post your 65th birthday. Last but not least, seek advice through a financial planner. Research shows that Australians are at least 20% better off if they've sought advice off a financial planner. We achieve this by the strategies that have already been mentioned, but also through guiding you through complex areas such as maximising your government entitlements and providing you guidance with estate planning so that your wealth can transfer over to your children or future generations like our business name suggests. I'd like to take this opportunity to thank you again for allowing us to provide you with this presentation, and we hope that you've learned something throughout. And now I'm going to pass you over to Dean.
Thank you for listening in today. We'd also like to thank the Melton City Council Learning Directory for inviting us to present. If you need any further information of what we spoke about today, please contact us directly, myself or Emilio, as you can see by the contact details, or when we're available to come into the office, please we can come to Unit Street in Melton.